Most people completely misunderstood yesterday's silver move because the price action itself was never the real story. What actually mattered was the sudden change in tone, urgency, and emotional messaging surrounding an otherwise predictable market event. Markets have a rhythm, and when that rhythm breaks, it usually signals stress building beneath the surface. Yesterday didn't feel normal because the system itself was uncomfortable, not because silver suddenly became weak. When explanations turn emotional instead of analytical, someone is trying to influence behavior rather than share information. This wasn't a warning from the market, it was a request from the system for liquidity. The dominant narrative framed the move as routine, yet strangely demanded immediate attention and fast reactions. Truly harmless events never require this level of persuasion or coordinated explanation across platforms. Silver wasn't being sold because it failed, it was being sold because it outperformed everything around it. Passive commodity indexes do not think, predict, or form opinions about metals or macroeconomic trends. They simply follow mechanical rules based on calendar schedules and relative weighting formulas. When silver rallied strongly over months, its weight inside those indexes quietly grew far beyond target levels. The rebalance wasn't a decision. It was delayed math finally catching up with reality. By the time execution arrived, the imbalance had already grown into billions of dollars. That scale mattered, but not in the simplistic way headlines tried to portray. Known events don't cause panic unless leverage makes even routine adjustments feel dangerous. Leverage thrives when liquidity is abundant and flexibility remains high across the system. When inventories tighten, leverage becomes fragile and narratives become louder. Yesterday's fear wasn't about silver collapsing, it was about silver not falling enough. Certain positions needed relief, and relief requires sellers willing to act quickly. That's why urgency replaced calm explanation across financial commentary yesterday. Forced selling from passive systems does not reflect belief, conviction, or future expectations. It reflects obligation, and obligation always ends once rules are satisfied. Those sellers are finite, predictable, and temporary by design. Strategic buyers understand this difference and wait patiently for mechanical pressure to exhaust itself. Physical demand does not respond to headlines. It responds to availability, cost, and long-term necessity. For industrial buyers, price dips caused by forced selling represent opportunity, not danger. Silver today is not just a trade, it is an input tied to infrastructure and energy systems. That reality creates a price floor invisible to paper-focused analysis. When paper prices disconnect from physical value, arbitrage quietly moves metal across borders. Metal, leaving trading pools, reduces flexibility for financial structures built on rolling exposure. Each ounce absorbed physically tightens the system a little more. That tightening does not show immediately on charts, but it increases future sensitivity. Markets become more reactive as buffers shrink and margins for error disappear. Yesterday revealed how close the system already is to those limits. The loudest warnings often appear when time becomes the real enemy. Time cannot be hedged, rolled, or managed with creative accounting. Structural demand operates on long horizons that ignore short-term volatility. That mismatch is deeply uncomfortable for leveraged paper positions. The system tried to externalize pressure by encouraging public participation in selling. Selling late provides liquidity to those who already sold early. This is how wealth transfers quietly during moments of confusion. Most participants reacted to visible price moves instead of invisible positioning shifts. Institutions adjusted months ago, not yesterday, because they understood the mechanics. Yesterday was the completion of a process, not its beginning. Completion phases often generate maximum noise because narratives need urgency. Panic usually peaks after the most informed actors have already acted. This event was never about collapse. It was about control slipping incrementally. Silver inventories are tighter now than most models comfortably assume. That makes every forced flow matter more than it would have years ago. Passive selling creates dislocations that opportunistic capital waits to exploit. Once forced sellers finish, market character often changes abruptly. Volatility compresses briefly, then direction reasserts itself based on fundamentals. Fundamentals did not weaken yesterday, despite how the narrative suggested otherwise. Industrial demand did not disappear, it simply waited. Waiting demand is confident demand, not fearful demand. This distinction separates structural analysis from surface-level reaction. Markets under stress attempt to manage perception before reality asserts itself. When persuasion replaces price discovery, something beneath is already strained. The rebalance was convenient because it gave fear a recognizable name. Naming an event helps redirect attention away from deeper imbalances. Those imbalances are rooted in leverage meeting physical constraint. Physical constraint always wins eventually, even if paper delays the outcome. Yesterday slightly reduced the flexibility available to manage future stress. That matters more than any single day's price movement. Calm markets with shrinking buffers are more dangerous than volatile ones. Stability can mask vulnerability when ownership shifts towards strong hands. Strategic holders do not sell into strength or weakness easily. That reduces future liquidity when prices finally need to move. The market today is transitioning from surplus psychology towards scarcity psychology. Transitions are messy, confusing, and often misunderstood in real time. Headlines prefer dramatic endings, but markets usually change through attrition. Yesterday was one more step in that longer process. Nothing broke, but something tightened again. Each tightening increases the cost of maintaining leveraged exposure. Eventually, trades stop working not because price explodes, but because risk accumulates. The system senses this long before retail participants do. That awareness explains the urgency far better than price charts. Silver didn't fail yesterday, it exposed discomfort. Discomfort appears when old structures struggle with new realities. Financial abstraction is colliding with material necessity. Material necessity does not negotiate with narratives. It absorbs supply quietly and waits. Yesterday created better conditions for that absorption to continue. The real signal was not volatility, it was coordination. Coordination means interests aligned under pressure. Pressure means margins are thinner than they appear. Thin margins make future events more impactful, not less. Understanding structure matters more now than reacting to noise. If you want clarity instead of headlines, stay focused and stay subscribed.